Okay, you can see my my screen, right?
Yes, the case, and it's recording already.
It's recording now? Okay. Perfect. So welcome everyone. Welcome to the FSA Fundamentals webinar with Pillars of Wall Street. Thank you very much for attending. This is Alok Modi. My email address is up on the screen, amodi@pillarsofwallstreet.com. Feel free to reach out to me at any point with any questions post-webinar. And we're here for you for the rest of the semester here. We'll be running a number of webinars for everyone. And we really want to make sure everyone is learning, everyone is grasping the material. So again, this is the reason we always provide our contact info to the extent that you guys have any questions throughout this webinar series. Feel free to reach out at any point. I'm more than happy to help, of course. Now, we're going to be kicking it off today with FSA. Okay, so today is more of an intro level course, as is the next course as well this week, Intro to Excel. Okay, and then we'll be taking a deeper dive into these concepts over subsequent webinars. Let's get started here now. What we're going into today is the financial statement analysis fundamentals deck that you should all have from us. Okay, so everyone should have this this FSA deck. Now, we're going to be covering the core FSA concepts at a high level today, and again, taking a deeper dive in subsequent webinars. So today is more of an intro level FSA webinar, making sure everyone is familiar with the core accounting concepts that we need in the future. The goal here today is really to understand accounting from a financial analyst's perspective. Okay, not so much a traditional accountant. We're looking at things from a financial analyst's perspective. That's important to keep in mind. Okay, so for example, some of you might have taken accounting in school at some point. Well, you've seen concepts like debits, credits, T accounts, all of that good stuff. Well, are we focusing on any of that? No. Okay, the focus here will be on understanding a company's historical performance in order to think about what might happen in the future. Okay, the bulk of what we're focusing on primarily has to do with the projections of a company, the future of, right? Because down the road, we're ultimately going to cover modeling, valuation, topics like that. And ultimately, if you really think about it, what drives the value of a company? What are we focused on when modeling financials? It's the future, it's the projections, because that's ultimately what drives a company's value. Okay, so the only reason we frankly care about a company's historical financial performance is it's going to help us think about what's going to happen in the future. And that's an important high-level point to keep in mind as we move through the slides here. Okay, so we're going to be focusing in on the three financial statements in this webinar: the income statement, the balance sheet, and the cash flow statement, and primarily how they're interconnected. And then we're going to proceed into a more detailed dive on the income statement, balance sheet, as well as cash flow statement. But again, it's still at an overview level in the sense that in subsequent webinars, we'll be taking a deeper dive into all of these concepts. So something I just want to point out. Okay, so with that, let's get going now. Here are the topics, right? Just a table of contents. This is the order in which we're going to be proceeding through the material. Let's first begin with an overview of the three financial statements here, okay, as well as the financial reporting system. Now, in the U.S., in the United States, the organization, there's a lot of acronyms here, so make sure you guys are taking notes. And always take notes. We always stress that it helps to remember things. So just as many acronyms as we have here, make sure that you guys are taking notes as we go through and define each one. Important that you be able to quickly recognize what each acronym stands for and what it means. So first, we have FASB US GAAP. Okay, so the organization which establishes and improves accounting standards in the US, that's called the FASB, okay, Financial Accounting Standards Board. Now, the accounting system itself is known as GAAP, Generally Accepted Accounting Principles. Okay, in the US, every single public company, right, there's thousands of them, every public company has to file an annual report at the end of every fiscal year. That's called a 10K. That's the annual report, a 10K. Every public company also has to file 3 quarterly reports. Those are the 10Qs. At the end of their fiscal quarters 1, 2, and 3, and then at the end of fiscal quarter 4, well, that's when the 10K comes out. So technically, there's 3 10Qs and 1 10K every public company files each fiscal year. Something to just point out as well, that 10K has been audited by a public accounting firm. Okay, think E&Y, Pricewaterhouse, right? It's been audited by a public accounting firm, whereas the 10Q is not audited, right? So the 10Q is not audited, but the 10K is. But that doesn't mean you can't rely on the 10Q. Of course you can, right? Management is still responsible for ensuring the accuracy of all of those reports. Now, internationally, we have something called IASB, right? Similar to FASB, except the I is international. So IASB stands for International Accounting Standards Board. Okay, International Accounting Standards Board, just like FASB is Financial Accounting Standards Board. Okay, and IASB, they basically govern the standards, right, which are IFRS internationally. And that's the system, IFRS. What is IFRS? Well, IFRS is International Financial Reporting Standards. Okay, International Financial Reporting Standards. Internationally, every public company releases 1 annual report covering the fiscal year, just like in the US with the 10K. But instead of 3 10Qs, right, 3 reports, they release only 1 throughout the year after 6 months into the year. So they have 1 report at the end of the fiscal year and then 1 6 months into the year. So overall 2 reports instead of 4, like in the US. Okay, and once again, the annual report is audited. The interim report 6 months into the year is not audited. Now, keep in mind, I keep saying fiscal year. So just to be very clear, right, for those of you especially new to a lot of the terminology here, what is fiscal year? Well, that's a company's financial year. It does not have to be December 31st. Okay, when you think of a year in general, you think of, oh, January 1st is the start, and okay, and December 31st is the end. Well, that's a standard calendar year. But a fiscal year doesn't have to end on December 31st. Does it for many companies? Sure, but it doesn't have to. Okay, it doesn't have to. The way that this all works is the fiscal year typically coincides to a company's business cycle. Okay, now you might be wondering, why would a company choose a year end date other than December 31st? Well, depends on when the business cycle ends. But think about, a Walmart, a Target, right? Think about these retailers. They have January 31st fiscal year ends. Why? Well, they want to make sure they capture all of the holiday sales, right? Post Christmas time, post New Year's, all of the sales within their fiscal year. They don't want, the sales on December 28th to be in one fiscal year, and then basically it's the same shopping season, right? So then January 3rd rolls around, and all of a sudden it's a different year. Well, it's really the same, the same shopping season. So they want to put all of that into the same fiscal year, if that makes sense. Okay, so that all, rolls up into the same fiscal year ending on January 31st for Walmart, for Target, for those types of retailers. And every company is different. Okay, Microsoft, has a June fiscal year end. Every company out there is different. So you just have to figure out, just go to the SEC website and you can quickly figure out, when the latest 10K was released, and then you would know when the fiscal year ends. Okay, now let's keep going here. Primary sections of the annual report. So here we have 3 buckets. Okay. MD&A, we have the 3 statements in the middle, which is the focus of the webinar, and then we have the notes. In addition to the statements, which is the focus here, we also have the MD&A and the notes, which are important to examine as well. Okay, what is MD&A? That stands for Management Discussion and Analysis. Okay, that's Management Discussion and Analysis. That's the one section of the report that allows you to understand management's perspective on the business, both historical and potentially the future. It's really, the way I look at it is it details the whys behind the numbers, meaning Why is this going up? Why is that going down? Okay, the three financial statements just give you numbers, right? Numerical data. But the MD&A allows you to understand why the numbers are what they are. So for example, why did sales go up? Why did sales increase? Why did expenses go down, right? Why did they decrease? What's management's take on future CapEx, right? These are the kinds of things they discuss in the MD&A. Okay, another way of looking at this is your one chance to sit down with management on a one-on-one basis and truly glean their insights into what's going on behind the scenes, right? Again, the financial statements just give you numbers, right? Here's the income statement, balance sheet, cash flow, great. There's all the numbers, but I have no idea why, right? Why are the numbers moving the way they are? Okay, why did the costs all of a sudden go up, right? Why did the sales go up or down, right? So why? That's not going to be explained. But you might see, expenses go from 5 billion to 6 billion. Well, that's fantastic, but why? Right? Sales might go from 10 billion to 8 billion, went down. Well, why? Right? So this is why you have to look at the MD&A and read the MD&A. It takes some time because you have to go through and read all of it, but it's an important exercise to do to truly understand the business and what's going on. Now, the notes section at the bottom, right? You see notes, the box at the bottom. Well, what's the difference between that and MD&A? So the notes actually further clarifies the different accounts in the statements. And when we say clarify, we mean just breaks out in more detail. So it doesn't explain the whys, right? That's the job of the MD&A. But the notes, they basically detail out a lot of the accounts. So, the most common example is debt. The balance sheet might say total debt is $1 billion. Well, that's great, but I need a little more info there. I want to know all the different types of debt. What are the different tranches of debt, right? Split out between the different tranches of senior debt, junior debt. I want to know exactly what types of debt they have. I want to know when the debt matures. What's the maturity of each tranche? What are the interest rates associated with each tranche of debt? Right? All of that's not going to be on the balance sheet, right? The balance sheet might just say long-term debt, $1 billion. Great. Well, where do you get all the detail? Look at the footnotes. Okay, so this is the point of the notes. They break out a lot of the accounts in a lot more detail. Right, other items they break out are PP&E, property, plants, and equipment. We're going to get to that when we discuss fixed assets. Inventory by type, right? Different types of inventory depending on the stage of the inventory. Broken out by raw materials, work in process, finished goods, all of that. Even revenue and profit by geographic region or business segment in detail. Right, so these are the kinds of things you would find in the notes section. To key financial statements. Here are the statements we'll be examining in detail: income statement, balance sheet, and cash flow statement. Now, just big picture. The income statement provides you with the profitability over a period of time, right? Starting with sales, which represents all of the revenue the company has generated during the period, and then subtracts all the expenses associated with that revenue, and ultimately arrives at net income, which is the bottom line or the profit for the firm. Now, the balance sheet, that represents the financial condition or financial position of a firm at one point in time. Right? The big picture here is that a company raises debt and equity, which are sources of capital, and then invests this capital in the operating assets and liabilities of the company. Okay, that's the way that all works. Now, it's these operating assets and liabilities, right, that the company invests in, that generate profit, right, and ultimately cash flow, which is important for the company. And therefore, that's what creates value for shareholders. It's the operations of the firm. And we're going to dive into this more detail, especially when we hit valuation, when we start to talk about value creation and all of this. But for now, just realize that it's the operations of the firm, the operating assets and liabilities, which truly drive value for the company and its shareholders. Finally, the cash flow statement represents the changes in cash over a period of time, right, showing the inflows and outflows of cash during the period. And we're going to go through all of this again in detail, in some level of detail in this webinar, but definitely in a lot more detail in subsequent webinars. Here's the fundamental accounting equation, the fundamental accounting equation. Assets equals liabilities plus equity. Okay, the assets on the left represent all the resources of the firm, essentially uses of funds. what a company owns, basically. The liabilities represent all the obligations of the firm, right? Basically, the creditor's claim on the firm's resources. The equity represents the residual interest in the firm by shareholders. Basically, it's the assets minus the liabilities. Okay, that's the equity. Essentially, equity is ownership. Okay, think about equity as being ownership. If there's no liabilities, well, then the assets equals the equity, and the equities own everything, right? The equity holders own everything, right? But frequently, of course, we will have liabilities, and therefore, assets won't equal equity. Assets will equal liabilities plus equity, with the equity being whatever is left over after the liability, the liabilities are satisfied. And to keep in mind that the two sides of the balance sheet must always be equal. Right, the assets must always equal the liabilities plus the equity. Basically, the total source of funds on the right must always equal the total uses of funds on the left. Okay, this has to always hold true at every given point for basically every company out there. Okay, here are the key links. The statements, as we alluded to earlier, are interconnected, right? They're not standalone, but they're very much interconnected. The net income at the bottom of the income statement is connected to retained earnings on the balance sheet, right? It actually feeds retained earnings on the balance sheet. And as the name implies, retained earnings, that represents all the earnings or net income of the firm that the company has chosen to reinvest and not pay out via dividends to shareholders. The net income also feeds the top line of the cash flow statement. So net income is the starting point of the cash flow. The goal of the cash flow is to then take that income and actually reconcile it into a cash figure. And then that cash figure at the bottom of the cash flow statement is ultimately what ties the cash flow statement to the balance sheet, because the top line of the balance sheet is cash. And we're going to be exploring these links in more detail throughout this module. Another thing to point out, the income statement tells us absolutely nothing about cash. So just for some of you, I'd be wondering, well, why does the net income tie to the cash flow, and then that solves for cash? Isn't net income cash? No, net income has absolutely nothing at all to do with cash. The net income has nothing to do with cash. Net income is very much based on accrual accounting, and we're going to talk about this in the next section. Okay, so just keep in mind that the income statement tells us absolutely nothing about cash. To figure out the cash inflows or outflows and the final cash balance, you have to go to the cash flow statement, where the reconciliation is to get from net income to a truly cash figure. Here is just a quick snapshot of the key links showing you, three statements with these interconnections in action, right? So you see all of the different links here. You see net income, how the net income circled in red on the left in the income statement. Those net income numbers tie to the top of the cash flow. It's the same figures, right? And at the bottom of the cash flow, the two cash figures tie to the top of the balance sheet. It's the same numbers. But then how come the net income on the income statement isn't the same exact number as the balance sheet retained earnings? Because retained earnings is a cumulative number. Keep in mind, retained earnings goes up by net income and down by dividends. So it's a cumulative number, whereas the income statement gives us the flow for the year. So whereas on the balance sheet, the number is, it's a cumulative number since inception. The income statement just gives us the flow. Each of those numbers represent the number for that year only. Okay, and then the other thing is there's something else called, if you notice next to retained earnings, it's in small font, but you may be able to see that. It says accumulated other comprehensive income. That's something else we're not getting into, and it's not something we project anyway. But the bottom line is there's other things buried in the historicals that'll cause a deviation from what you may expect, okay, in terms of what the retained earnings number should be. But that's fine. That's the past. Okay, this is the past. You just take the numbers as they are, and it's really the future which we're focusing in on. Okay, which we're going to focus on when projecting the future. Okay, so this is all the past again. Okay, so now, any questions so far? So I just want to see if there's any questions here at all. If any questions at all here on anything. Okay, everyone good to go? Okay, perfect. So let's keep going here. Just want to make sure, can everyone hear me? I haven't heard a peep from anyone, so I just want to make sure everyone can hear me and see my screen. If you want to just confirm that, please.
Yeah, we can hear
Yeah.
you. The screen is
Excellent.
Yeah, we can hear you.
Perfect. Excellent. Just want to confirm. Every time 20 minutes goes by and I don't hear a peep, I just want to make sure that the connection's working, all of that. So just every now and then just jump in if you don't mind, and just let me know that you're good to go, no questions. Or if you have questions, of course, just jump in and feel free to ask as well. I'm really happy to help and answer any questions along these lines as well. Okay, so next we are taking a deeper dive into the income statement here. Okay, so we're taking a deeper dive into the income statement here. So let's get started with that now. What does the income statement tell us? Let's go into a little more detail. Let's get more granular. Well, the income statement tells us about the profitability of a firm over a period of time, broken down into revenue earned as well as the associated expenses incurred. Now, when you subtract all the expenses from the revenue, you obtain net income. Okay, now the expenses are broken down into cost of goods sold, SG&A, or selling, general, and administrative expenses, as well as interest and taxes. COGS, which is cost of goods sold again, that represents the manufacturing cost or cost to obtain or produce the products the company is selling. So what's SG&A then? Well, SG&A, that represents just general operating expense of the firm, not directly linked to inventory. So, expense is not linked to the manufacturing process. Interest expense, that represents the cost of debt financing. If you're using debt financing, but if you don't have any debt, then you won't have interest. By definition, what is debt? It's any interest-bearing liability, and we'll get to this later on. But debt, by definition, is any interest-bearing liability. Taxes, that just represents the income tax expense a company has incurred on its pre-tax income. Right, just as individuals incur and pay income taxes, right, to the IRS, to the tax authorities, companies have to as well. Keep in mind, again, as we said, the income statement tells us absolutely nothing about cash or cash flow. It represents accrual accounting, which means a company recognizes revenue as it's earned and expenses as it doesn't talk about actually, the amount of cash going in. And again, for that, we need the cash flow statement. Here's a sample income statement. There are a lot of important concepts here to discuss.
Could you repeat that last part? Your mic was like breaking up a little bit.
Yep, sure, definitely. So basically, an income statement tells us absolutely nothing about cash flow. An income statement is based on accrual accounting. What is accrual accounting? Well, accrual accounting means we are recognizing revenue as it's generated or earned and expenses as they're incurred, but not when cash is going in or out. So for example, I can make a sale to end up delivering the product, therefore recognizing a sale. But let's say my customer still owes me money. Well, I did recognize the sale. I sold the product. I physically, let's say I hand over the product to someone I'm selling, right? Let's say, I'm in the business of, selling books, right? And I end up selling someone a book and I give them the book. Well, I made the sale. But let's say they don't pay me yet. They're going to pay me in a week. Well, let's say I sold the book for $10. That means my sale was for $10. Does that mean my cash went up by $10? No, because the customer hasn't paid me yet, right? The bottom line is that there's a big difference between cash accounting and accrual accounting. Cash accounting is just simple. If a dollar comes in, hey, that's $1 in sales. If a dollar goes out, that's $1 in expense. But any public company, as well as any reasonably medium or large size private companies, use accrual accounting. It provides a better picture for shareholders. You don't have profits suddenly going up and down, skyrocketing up and then crashing, right? Just because of cash differences in inflows and outflows. But accrual accounting in a sense smooths that and gives a more accurate picture to shareholders. So from an accrual accounting point of view, we're only recognizing revenue as it's generated, right, as we're actually selling products and services, and expenses as they're incurred, not when cash is going in or out the door. Okay, just a very important point to keep in mind when it comes to accrual accounting. Okay, any questions on that? So that's an important concept, accrual accounting. Okay, the complete opposite of cash accounting. Your local, your local deli, your local, flower shop down the corner likely uses cash accounting. Okay, because it's easy for a small business, like that to just keep track of cash going in and out, right? But for any, again, a large size business, definitely any public company, right, that has thousands, if not more, transactions going on every week, every month, you need to use accrual accounting to keep track of everything. You're not cash accounting. Okay, sample income statement. Lots of good things here to discuss. The top line is sales, right? Again, that represents the revenue the company earned during the given period. Okay, which represents both cash and non-cash sales, as we said. Nothing on this page tells me anything about cash. Right, next we have cost of goods sold. Right, that's the cost of manufacturing inventory or acquiring inventory. Right, let's say the company's a retailer like Walmart. Right, so they resell certain products that they buy. Right, so basically that's an example of where they may not be manufacturing everything they have; they're purchasing it from others and then reselling it. But that's also the cost of inventory, essentially, of acquiring inventory. So that would be COGS. Okay, we then subtract COGS from sales to obtain gross profit, which is essentially the manufacturing profit. Right? We then have selling, general, and administrative expenses, which are SG&A. Right? That represents general operating expenses of the firm. Essentially, SG&A is operating costs, right? They're operating costs not directly tied to the manufacturing process. So things like marketing and office expenses would be SG&A, right? Advertising, right? All of that good stuff would be SG&A. After subtracting SG&A from gross profit, we get operating profit or operating income. Okay, we then subtract interest expense to arrive at income or profit before taxes. And then finally subtract tax expense to arrive at net income, right, which is the bottom line. Okay, now something else to point out here. Note that operating profit, that's an earnings number available to all stakeholders of the firm. And we're going to get into all this more when we hit valuation, when we start getting into equity and debt, all the differences between the various stakeholders, their claims on the business, things like this. But at the moment, keep in mind that operating profit is an earnings number available to all stakeholders, both debt and equity holders. It's a pre-capital structure profit number, right? Because it's pre-interest. Okay, once we subtract out interest and taxes, we get net income, which is available to the equity holders of the firm. Now, if I asked you a quick question, how many profit lines do you see on this page? Well, the answer is actually 6. There's gross profit, there's operating profit, there's one in the middle, you missed, the profit or income before income taxes. That's still an earnings number, right? It's a subtotal, the income before income taxes. There's net income, and then there's 2 more at the bottom. We have basic and diluted EPS, or earnings per share. Okay. Now, gross profit and operating profit, they're both pre-capital structure available to everyone, equity and debt holders, whereas net income and EPS are for the equity holders only, because again, interest has been taken out by the time you get to net income. Now, something important to keep in mind here from a share count perspective as well, I want to point out, EPS at the bottom, earnings per share, how do we define that? Earnings per share is net income divided by the WASO, the weighted average shares outstanding. Again, EPS equals net income divided by WASO, which is weighted average shares outstanding, right? Because we need to compare net income over a period of time with the average share count outstanding over that same time period. Now, what's the difference between, you see basic and diluted at the bottom? Well, basic EPS equals net income divided by the basic WASO. And diluted EPS is net income over diluted WASO. Well, what is the concept of basic versus diluted? Well, basic weighted average shares outstanding, or basic WASO, only counts shares that have actually been issued and are outstanding, okay? Whereas diluted WASO includes not only those basic shares, so it includes the basic shares, but also other potentially dilutive items like employee stock options or restricted stock units. And more on all of these topics in valuation in more detail. We'll get to some of the math there behind these dilutive securities. But for now, just keep in mind that a company might issue, employee stock options, restricted stock units. A lot of tech companies do this actually to incentivize employees, right? So this is all part of compensation effectively. And you have to include the dilutive effect of them when calculating your diluted weighted average shares outstanding. Now, and the reason is because these items, the RSUs, the employee stock options, they're going to result in additional shares being issued in the future. Therefore, they're dilutive to EPS. Okay, meaning EPS on a dilutive basis will always be equal to or less than the basic EPS. You can't have dilutive EPS being higher than basic by definition, right? Because you look at it like a worst case scenario in a sense, right? If all the shares convert, EPS drops. How low does it go, right? So that's the idea behind dilutive EPS. Any questions on this slide?
Yes, we have Santiago Morales raising his hand. Feel free to unmute yourself and ask a question.
Cool, thank you.
Questions?
I think I may have missed it, but yeah, I think I may have missed it. But did you say that the basic EPS is basically just like what's owned by the shareholders, whether that be like preferred or common?
Well, okay, so not preferred. Let's clarify. So preferred shareholders actually are senior to common, but junior to debt. But when we're talking about earnings per share, we're talking about earnings per share to who? To common shareholders. EPS is a common shareholders profitability metric. So preferred is higher up, and they get their, Warren Buffett. It's actually the most common, most famous preferred stock investor, Warren Buffett, and he gets his preferred dividend ahead of you and I getting our common dividends. So when we talk about earnings per share at the bottom, EPS, we're only talking about common shareholders. But the idea is the difference between basic and diluted has to do with the fact that diluted accounts for the fact that a company may have dilutive securities like stock options, which can dilute the existing owners, dilute the existing shareholders. If there's more shares that are suddenly issued in the market, what's going to happen? EPS will fall. So that's what diluted takes into account. The fact that if there's now more shares, EPS will fall.
Gotcha.
Does that help?
Yeah, absolutely. Thank you.
Perfect. Yep. Yeah. Keep the questions coming, and very important. I want to make sure, especially during the first and second webinar this week on accounting and Excel, everyone understands the basics, because we're going to be building upon all these concepts in subsequent webinars over the next several months here. Okay. So now expenses, COGS versus SG&A. So what's the big difference here?
Before you go on further, could you explain? I think you said it's pronounced WASO or something like that.
Yep. So WASO is the weighted average shares outstanding. So basically that's the average share count for the year, okay, or for the quarter, depending on the time period you're looking at. So if I said what's EPS last year for a company, it's the net income for the whole year divided by the average share count for the whole year. What you can't do is take the most recent share count and divide it into the earnings for the year, because then you're comparing apples and oranges. Do we ever need the most up-to-date share count off of the most recent cover, the 10K or 10Q cover? Yes, when doing valuation, right? And we're going to get to this in valuation. When calculating things like market cap, you need the most up-to-date share count. But when calculating ratios like EPS, you want to make sure the numerator and denominator are being compared on an apples-to-apples basis. So therefore, you want to make sure that you're taking the net income over the year divided by the share count over the same time period. So that's why we need the weighted average share count for the time period that's covered by net income. Okay, so you're comparing apples to apples. That's the point. Okay, questions here?
Okay, thank you.
Yep, of course. Yeah. Okay, so now COGS and SG&A. There's a lot of operating expenses a company has, but most are broken down into COGS and SG&A. Okay, again, COGS is the cost of goods sold. Okay, that has to do with expenses company incurs in terms of manufacturing the product they sell, right? So things like inventory, production labor, transportation expenses, right? Expenses having to do with the products they're selling. Whereas SG&A, selling general and administrative expenses, are general operating expenses a company incurs, not tied to production of products that they sell. So things like rent for the corporate headquarters, insurance for the corporate headquarters and employees, advertising expenses, okay, salaries for management team, right? So all of these types of items are SG&A, right? Just general operating expenses. Okay, but keep in mind that things like rent, insurance, labor, utilities related to a manufacturing plant, that's actually going to be in COGS because those costs are related to producing inventory that the company sells. Okay, whereas the same line items, things like rent, insurance, labor, utilities, related to the, let's say, corporate headquarters, right, related to the executives, let's say the HR department, all of that, that would be SG&A because that's not directly tied to producing inventory. So that's how you want to really break out items. A lot of people just memorize, oh, this goes here or there. It's not about memorizing. It's about understanding what the expense, pertains to. Is it pertaining to general operations or pertaining to products the company sells, right? That's the question you're really asking here. All right, EBIT and EBITDA. Okay, these are two of the most important terms in life that you all need to know, especially EBITDA, right? I'm sure many of you have heard of these terms, and we're going to be coming back to this again and again in virtually every webinar in some form, right? Because these are very important terms, very important earnings metrics you need to understand, especially in corporate finance. You hear these all the time. You're modeling, you're valuing companies. You're always seeing these items. They're always in front of you. So we have to make sure we understand exactly what they are, what they mean, how to calculate them, and that's part of what we're going to be doing in a lot of the accounting webinars. We're going to be focusing in on these concepts here. So let's get into them. What is this? EBIT is earnings before interest and taxes. EBITDA is earnings before interest, taxes, and D&A, which is depreciation and amortization. Okay, D&A, again, is depreciation and amortization. Okay. Depreciation representing the spreading out, okay, the spreading out of the cost of PP&E over its useful life, whereas amortization is the spreading out of the cost of intangibles over their useful life. Okay, we're going to get into that in more detail in a bit. Now, EBIT is very similar to operating profit. However, it represents a recurring figure, an ongoing figure. Okay, so it's a non-GAAP metric. When we say GAAP, we mean the data, the numbers the company gave us in their 10K and 10Q, basically. That's GAAP. When we say non-GAAP, we mean adjusted figures we've come up with, okay, that take into account any non-recurring income or expenses. So EBIT is, again, very similar to operating profit in that it's before interest and taxes, but it's been adjusted, okay, for any items which are not recurring in nature. So things like restructuring charges, litigation gains or losses, impairment charges, right? These are not things we're in the business of projecting, so you want to back them out from operating profit to get to EBIT. That's the point. So for example, maybe you incurred a large cost this year in order to restructure your business. Well, that would be a one-time cost, and we would add it back to operating profit to get to EBIT. That's the point. Okay. The idea here is that EBIT is essentially normalized for non-recurring items. Okay. Normalized for non-recurring income and expenses. And all we care about, frankly, from a projection standpoint, is normalized or continuing information, right? Normalized or continuing earnings. That's all we care about, frankly. If something is not going to happen again, we're not interested in it, right? If you said you had this lawsuit this year that cost you $5 million, well, and it's a one-time thing, am I going to build in my model? I'm going to have that $5 million lawsuit expense every year for the next 5 years? No, of course not, right? It's only a one-time thing. So if the profits this year were lower because of that $5 million lawsuit, I'm going to say, you know what, on an ongoing basis, the profit this year would have actually been whatever it was plus the 5 million, right? Because this way you're getting the effect of that one-time item. Otherwise, it's going to skew the results. Otherwise, when you compare the historicals to the projections, it won't make much sense. So we have to make sure we're normalizing the past and using those normalized set of financials to project going forward. Okay, a very important concept there. We're going to see all this in the modeling when we get to it as well. Okay, how we normalize the past and use the normalized set of data to project going forward. Now, what's EBIT then? Well, EBITDA rather. EBITDA is an offshoot of EBIT. Okay, it's simply EBIT plus DNA. DNA, their non-cash expenses related to PP&E and intangibles, as we said, and they can be found in the cash flow statement as a non-cash add back. Okay, essentially both EBIT and EBITDA are pre-capital structures since they're earnings before interest expense and interest income. Right, so meaning they're available to both equity and debt holders. So everyone is interested in EBIT and EBITDA, equity holders as well as debt holders, as opposed to, keep in mind EPS, right, and net income, which only equity holders are interested in because net income and therefore EPS is post-interest, right? But EBIT and EBITDA are pre-capital structure, therefore available to equity and debt holders. So it's of interest to both equity and debt holders. Now, net income versus EBIT and EBITDA. Okay, so we touched upon this on the prior slide, but again, just to reiterate, net income is only available to shareholders because interest has been taken out, whereas EBIT and EBITDA are pre-capital structure, pre-interest, therefore available to all stakeholders of the firm, the equity and debt holders. Okay, profitability ratios. An important metric here are used to determine how efficient a company is in managing costs is a profit margin. Okay, what you can see at the bottom is any of the profit lines divided by sales, right? So what's gross margin? Gross profit divided by sales. What's operating margin? Operating profit divided by sales. Okay, what's EBIT margin? EBIT divided by sales. What's EBITDA margin? EBITDA divided by sales. Okay, and the net income or profit margin is the net income divided by sales. Okay, everything is over sales essentially. That's what a margin equals. Now, profit margins, they help analysts compare one company to other comparable companies. Okay, so this way, if two companies have very similar sales number, well, the company with the higher margins is generally considered more attractive since it's done a better job managing costs. Okay, in general, you want to compare ratios across firms in the same sector. Okay, because otherwise you're comparing apples to oranges. It's like with anything else. Similar to working capital, when we get to that in the next section, you can only compare companies within the same sector. Otherwise, it doesn't really prove any use if you're comparing a technology company with, let's say, a company in a different sector, right? So a consumer company with the healthcare company, with an industrial company. If you're comparing companies in different sectors, it's not as helpful because different sectors naturally have different margins, right? If you think about a service business, naturally the margins are going to be higher. There's less, fixed capex, fixed costs than a manufacturing business, right? So in general, what you can't do is take, a Tesla or a Ford and compare it to a Microsoft or an Apple, right? You're talking about two very different types of industries, companies, and therefore, business models, right? So you have to keep that in mind as you're thinking about companies. You can only compare apples to apples, right? So if we say, hey, a company has 30% EBITDA margin, is that good? Well, that's not enough information at the moment for me to tell, right? I need to know what the competitors are. If you tell me all of their competitors, let's say they have 15 competitors, and all of them are, let's say they all have 50% EBITDA margin, and this company has 30%, I would say, oh, that's not good, right? But if you said all of their competitors have a 10% EBITDA margin, and this company has a 30% EBITDA margin, I'd say, oh, that's fantastic. So that's the way you want to be looking at this on an apples to apples basis. All right, now working capital. Any questions before we dive into the next section? Now we're starting with the balance sheet here. Any questions on the income statement information?
Is that why EBITDA is used as a proxy for cash flow and like that apples to apples comparison?
Yep. So EBITDA is used as a proxy for cash flow. Yep. Because, and the idea there is because it's essentially before DNA. Okay, essentially before DNA. Is it actual cash flow? No. And this is where it gets a little tricky. Warren Buffett always makes his famous quips, right? He says he doesn't like EBITDA as well. Basically, he always asks, hey, who's paying for the capex, the tooth fairy, right? So at the end of the day, it's not true cash flow, but in general, Wall Street uses EBITDA as a proxy for cash flow. That's correct, and that's because it's before DNA, which are non-cash expenses. Okay, and also EBITDA allows us to normalize for differences in DNA. If one company happens to spend a lot of money upgrading equipment and another doesn't, well, does that really have to do with the operations of the firm? Not really, right? Let's say Walmart upgrades all their equipment, Target doesn't. Well, you don't want that to skew your perception of their operating results, their operating performance. So that's an example where EBITDA would be more helpful, as opposed to using EBIT, right, which is after DNA. Okay, so it's because it's before DNA, which are non-cash expenses. So often that's used as a proxy for cash flow. Okay, but it's not true cash flow, right? Because it doesn't account for things like working capital and capex, which we'll get to as well in subsequent sessions here, subsequent sections of this webinar. So working capital, that's essentially the next component here. That's the first piece of the balance sheet now we're starting off with. Okay, so essentially current assets and current liabilities. Now, first let's begin with the definition of current assets and current liabilities. So current means 1 year or less. Okay, current means 1 year or less. So basically, with respect to assets, a current asset represents an asset which is cash, or an asset a company expects to turn into cash within a year. So look at the top here, look at the box at the top. These are the major current assets. Here we have cash and cash equivalents, that's money in the bank, or a very short-term investment that can be turned into cash within 90 days. Accounts receivable, that's money owed by customers to a company for products or services provided on credit. Okay, inventory, that can be classified into one of three categories: raw materials, work in process, or finished goods. Okay. Raw materials are used in the manufacturing process, right, initially. Work in process, that raw materials in the process of being converted into finished goods. And then finally, finished goods, that's inventory, that's finally ready to be sold. We have prepaid expenses, right? These are recognized when a company pays for a service in advance. And the most common example is insurance. You join a company, the company prepays your insurance, right? And then you have access to, let's say, doctor, physicals, things like this over the subsequent month, right? So in advance, the company's prepaying your insurance. That's an example of a prepaid expense and asset, right? Because you, as an employee of the company, are owed something. You're owed, the right to go see a doctor and all of that. So basically, that's a prepaid expense. Now, with respect to, and don't worry about deferred income taxes at the moment. We'll get to some of these advanced concepts down the road, but deferred income taxes, that's a more complex balance sheet line item. Again, don't worry too much about that at the moment. You see that here as well at the top, deferred income taxes, right? So that's something, just at a high level, that arises when there's a difference between the accounting value and the tax value of a balance sheet item. But again, that's all you need to know at the moment. It arises when there's a difference between the book value or the GAAP value, and then the tax value of a particular asset or liability, right? When there's a difference, then DTL may arise. So that's something that we'll get to down the road. Now, going to the other side of the balance sheet with respect to a liability, a current liability is a liability which the company plans on paying off within 1 year. Okay, within 1 year. The major current liabilities are in the box at the bottom. You have accounts payable representing money owed to suppliers for goods or services bought on credit. Okay, we have accrued expenses or accrued liabilities here representing, so what is that? Accrued expenses. Well, these are expenses recognized before the cash is paid out. And a good example is employee bonuses. As you work throughout the year, a company actually accounts for your bonus even though they don't pay it out till the end of the year, right? It's accrued because you're working for it throughout the year. So they build up that accrual throughout the year, and then at the end of the year, they end up paying out the cash to all the employees. What about debt? We have short-term debt as well as current portion of long-term debt. Well, debt is defined as any interest-bearing liability, and we alluded to that earlier, right? So debt is any interest-bearing liability. And we're going to be exploring debt further in subsequent sections here. But basically, debt is any interest-bearing liability. So where it says short-term debt, that's due in less than 12 months. The current portion of long-term debt, that's the portion of the long-term debt that's due in less than 12 months. Okay. Now, let's keep going here. Traditional working capital. What is this? Well, the accounting definition of working capital is current assets minus current liabilities. However, the corporate finance definition that we care about is a bit different. Okay, it's a bit different here. And we're going to see this on subsequent slides as well. Okay, so again, working capital, just at a high level, if you've taken an accounting class, you've seen that definition in school, for example, right? You see the definition of working capital as what? Current assets minus current liabilities. Well, we care about something a little different than that. Okay, we care about something a little different. What do we care about? Something called operating working capital, and that's where we're headed. Now, next slide here. On the balance sheet, we contrast the difference between a balance sheet from an accountant's perspective and that of a corporate finance professional. On the left side, we break out assets and liabilities into current and non-current. Right, on the right side, well, it's a bit different. We break out things into financial versus operating. Remember, as corporate finance professionals, we care about the operations, the operating elements of a firm, right? Because ultimately, the value of a firm is driven by operations, not financial components. Just big picture. Think about an Apple or a Microsoft, right? We're all familiar with those companies. Likely everyone here probably has at least one product from at least one of those two companies, right? Apple and Microsoft. Computers, phones, and so forth, right? So the point is, what drives operation? They both have an enormous cash pile, 100 billion plus in cash, right? Is that driving value? Well, not necessarily. If you told me Microsoft or Apple has, instead of 100 billion, now they have 150 billion in cash, would I be more, incentivized to go invest in one of those two companies? Not necessarily, not really, right? Because that's not what's driving value. What drives value is the fact that they're going to sell more. In the case of Microsoft, let's say, Office products in the future. In the case of Apple, more iPhones in the future, right? This is what's going to drive value for these businesses, not the fact that they have this enormous 100 billion plus cash pile sitting in the bank, earning very low interest rates these days, right? Maybe 0.5%, 1% interest rate. Maybe they have some of that in the market, right? Via marketable securities, long-term investments. But even then, the bottom line is, what's driving actual value? It's the operations of the firm. That's why you want to invest in these companies, right? Potentially, right? Maybe you do, maybe you don't. But if you do, it's because of the operations, right? It's not because of the fact that they just happen to have a lot of cash lying around. Okay, and that's ultimately what drives a lot of our thinking about how we separate these components out. Okay, so now let's get to the definition here, OWC. We're going to be seeing this especially when we get to the modeling. The operating working capital, current operating assets less current operating liabilities. Okay. This is also known as net working capital. Okay, this is also known as net working capital, net working capital. You'll see that term a lot as well. And again, the focus here is on operations. Now, the current financial components, so you see on the left side, let's make sure we know what goes in each of these buckets. The current financial components are primarily cash, short-term investments, marketable securities, current portion of long-term debt, dividends payable, and interest payable, right? These are all driven by management decisions, not operations. So you want to focus on working capital net of these financial components. Okay, so again, you want to focus on all of the current assets and current liabilities except for the financial components. Okay, so things like cash, investments, marketable securities, current portion of long-term debt, dividends payable, interest payable, they're all financial. So you don't want those. You want to strip them out of your working capital calculation when calculating operating working capital. Okay, so now, and one note on that, by focusing on these current operating components and excluding the financial components, right, you're better able to understand whether a company's operations are requiring or providing funding during the operating cycle. Okay, so let's get into that. Positive OWC requires funding, negative provides funding. Now, in positive OWC means what? That the operating current assets are bigger than operating current liabilities. Then OWC is positive. Okay. So you can see that on the left side, the shaded green box, right? That means positive OWC. Now, both sides are equal, right? The assets have to equal liabilities and equity. So if my operating current assets are bigger than operating current liabilities, well, what does that mean? That means that OWC shortfall must be funded by additional financing, right? In other words, positive OWC requires funding. Okay, if you're personally short on cash during the month, maybe you'll use your credit card to finance the shortfall. Okay, it's the same thing with a company. But a company may, they may end up using a revolver or a revolving credit facility, and that's actually, as once we get to the modeling, we'll see, going to serve as our liability plug. If we're short on cash, hey, draw down on the revolver. Okay, that's basically, what a company uses to fund shortfalls, okay, in cash during the operating cycle. Now, negative working capital means operating current assets minus operating current liabilities is negative. That's represented by the shaded box on the right side here. Okay, in this case, OWC is negative. It's basically providing or throwing off funding. Okay, negative OWC, it's a free source of financing, right? So think about a company that stretches its accounts payable or increases accrued expenses. Okay, these are examples of sources of financing. Okay, same thing with deferred revenue, right? A company, let's say an airline, collects all this money up front. Well, that's a source of financing, right? Because they're not going to fly you until, let's say, 2, 3, 4 months down the road when you plan on flying on the plane, but they collect your money up front. It's a form of working capital, right? It's a form of a source of financing, because they can then fund things like paying for employee let's say pilot and pilot and airline staff salaries, fuel, right? Costs like this, they can pay for all that just via the money they collect in advance from customers like you and me, right? Buying tickets in advance, right? So it's a form of a source of financing. Okay, deferred revenue, accounts payable, right? All of those types of operating current liabilities. Okay, here are common accounts. Right, so we have receivables, inventory, prepaid expenses accounts, payable, accrued expenses. If you want to throw in, deferred revenue, that's another good one. These are all very common. All right, non-current assets. Before we get here, any questions at all before we get to this slide here? Any questions at all? Everyone comfortable on the concepts here so far?
I have a quick question.
Yep.
So is a positive OWC or negative OWC preferred, or is it just not really matter? It's based on company by company, sector on sector.
Excellent question. So yeah, it's similar to when we discussed margins. It's not that OWC is good or bad, but you have to compare metrics of comparable companies. Okay, so when you look at certain industries, naturally they're going to have more positive, higher OWC. Other industries will naturally have lower OWC, like an airline, right? That's a good example of where you're just going to have a lot of deferred revenue. Naturally, that's the business model, right? Because the airlines collect money up front and then they fly you later. So a company like that, if you're comparing, you look at a lot of airlines, you'll see a lot of current operating liabilities, right? So those OWC figures will naturally be lower. Okay, so it's not so much that it's good or bad, but I would just look at it and make sure that you understand where the company lies relative to the competitors, and that goes with any ratio or any metric you're calculating in general. You want to understand where it lies relative to the competition, right? It's, by itself, these things only mean so much, right? If you said OWC is 20 million, or even as a percentage of sales, it's 10% or something, it doesn't mean much by itself, right? You have to always look at the competitors and then understand, what the relative significance is, rather than looking at it in a vacuum, if that makes sense. So that goes for, essentially any ratio of any margin calculation, right? Any of that we're looking at. Okay, so non-current assets. Here's an example of the non-current assets we're going to be talking about. All right, so look at the box section here. Okay, so we're going to primarily focus in on PP&E and intangibles. Okay, so PP&E and intangibles. That's what we're primarily going to be focusing in on here. Okay, so now you see goodwill, and we're going to get to that in M&A. So not really harping on goodwill too much. That's a whole lesson in itself, literally. Goodwill arises, just a quick note. In a transaction, you have an acquisition, goodwill arises if you pay more than the fair value of the net assets you acquire. But again, that's the extent of how much we're going into goodwill at the moment. It's again, we can spend 30 minutes talking about this concept, which we will once we get to all of the M&A concepts and topics down the road. Just keep in mind, goodwill is an intangible. It's not amortized. It's tested for impairment on an annual basis. Okay. But PP&E and intangibles are the ones we're really focusing in on this section. Now, big picture, what is non-current asset? It's the opposite of a current asset. Meaning what? Well, it's an asset that's not going to be turned into cash or consumed within 1 year. Okay, so it's basically, again, an asset that's not intended to be turned into cash or consumed within a year. PP&E and intangibles are the two big ones. PP&E is, again, property, plant, and equipment, essentially all the physical assets a company owns, like buildings, machinery, and land, which it, plans on using to generate revenue over time. Okay, now, intangibles represent what? Non-current assets with no physical substance. So what are examples of intangible assets? Someone give me examples of intangible assets here. Intangible assets.
Patents.
Say it again.
Patents.
Excellent. Patents. Yep.
A copyright.
Patents. What else?
A copyright on a song.
Perfect. Copyrights. Patents. What else? Think about Facebook. Think about McDonald's. Think about Coca-Cola. Think about Tesla. Well, what are these?
The brand.
Trademarks.
Boom. There we go. I like it. The brand. Yep. Brand name. These are all major intangible assets, right? Brands are not amortized because there's no useful life. Remember, to be subject to amortization, the intangible asset must have a useful life. Same thing with PP&E, must have a useful life to be subject to depreciation. So what major a PP&E asset is not subject to depreciation?
Land.
Land, exactly. In fact, it probably appreciates, goes up over time. Right? So on the balance sheet, it's just sitting at historical cost. But upon an acquisition, you would revalue it, right? And you would end up, paying for that increase in value upon an acquisition. So just something to point out. Now, let's look at the next few slides here. All right, so now we went through the key assets here, intangibles versus intangibles, right? What the differences are. Okay, so D&A, depreciation, amortization, right? How does this all work? Well, let's look at an example of how depreciation works. Amortization is the same thing, right? So if a company buys PP&E for 50 million, depreciates it over 10 years, the annual depreciation is $5 million. Right? Any non-current asset which does not have a useful life and therefore isn't subject to D&A is tested annually for impairment. What does that mean? That means the market value of the asset is less than the book value of the balance sheet, then it's impaired, right? So things like land and brands. All right, so now PP&E. This goes up with capital expenditures and it goes down with depreciation. This is super important. Keep this in mind. It's a very important page because we're going to need this in modeling. When we model, when we project, we're going to be projecting every single model we build. We will have a setup for this. PP&E will go up by capital expenditures or CapEx, C-A-P-E-X, CapEx for short, and down by depreciation. That's how you get to the ending balance, right? CapEx, that means you're buying tangible long-term assets like machinery. Depreciation, again, is spreading out the cost of the tangible asset over its useful life. It's a non-cash expense, right? The actual cash outflow occurs when you buy the equipment, the CapEx, essentially. Likewise, intangible assets go up by the purchase and down by amortization. Same exact concept, right? So for example, Microsoft buys a patent from Apple. Well, you're going to end up doing what? You're going to expense that via amortization. That intangible, that patent will be expensed via amortization over the useful life, right? Patents are typically, in the range of 17 to 20 years approximately. You're going to end up amortizing it over that useful life. All right, now let's get to debt and equity. These are the two primary sources of financing, debt and equity. Okay, so now debt and equity, these are the two primary sources of financing. What's the difference? Well, debt financing is obtained from lenders, equity financing from shareholders. Okay, debt is interest bearing. If a company takes out debt, they have to pay back the principal, which is the amount borrowed, along with any associated interest expense. So if they take out $100 million in debt, let's say at a 5% interest rate, well, they got to pay back the 100 at some point, either over time or all the way at the end, right? If it's over time, it's known as an amortizing loan. Otherwise, it's a bullet payment if it's all in one shot at the end, along with any associated interest. So then plus they have to pay the $5 million interest on an annual basis, until the balance is paid off, or until they pay the balance off. If they do over time, well, then the interest will go down as well over time, because the interest is based on the outstanding balance at that time. So debt is basically a senior claim over equity in the capital structure. It's a senior claim. Equity is junior, debt is senior. Think of it that way. Debt is obtained from lenders, whereas equity financing is obtained from shareholders. So if debt holders get their interest, how do equity holders get a return? Well, two ways. So how do equity holders get a return? We throw that question out there. How do equity holders get a return? You invest in Tesla, you invest in Microsoft, you invest in Verizon, in Netflix. How do you expect to get a return?
Capital appreciation.
Capital appreciation, what does that mean?
Like the increase in the stock's share price.
Yep, very good. So capital appreciation or an increase in the stock price. Perfect. So there's really two ways, right? There's capital appreciation, exactly what you said, plus what's the second way of obtaining a return? By investing in equity.
Dividends.
Dividend.
Excellent. Potential dividends, I'm going to say, because it depends on the company, right? If you're a mature business, right, think of, think of the blue chip companies, right? You have your Procter and Gamble's, your Home Depot, your Verizon's, AT&T's, your IBM's, okay? ExxonMobil, right? You have Boeing, right? These are Microsoft, Apple. These are all dividend-paying companies. Give me examples of prominent companies, big companies that don't pay dividends.
Amazon.
Amazon, good. Amazon does not pay dividends. Jeff Bezos takes all the money and reinvests it in the company, and therefore expects the company to grow based on their reinvested profits, right? So dividends just means you're taking part of the profit and paying it out to shareholders. So Amazon's a good example. What other companies do not pay dividends?
Tesla.
Excellent. Tesla, definitely not. In fact, they just became profitable over the last several quarters, right? And added to the S&P last month, right? So Tesla does not pay out dividends, right? What are other examples? Companies like Twitter, right? Companies like Netflix, companies like Facebook, right? And of course, all the newly public companies like Airbnb and DoorDash and Snowflake, right? None of these guys are paying out dividends. Okay, I mean, many of them aren't even profitable yet, right? But even those that are, right? Your Amazons and so forth, Facebooks of the world, they're not even paying dividends, right? Because they're reinvesting in growth. They're all in growth mode, essentially. Okay, so that's basically the big difference here. Any questions on debt versus equity? Very important page here to really understand the difference. Any questions here on the differences between debt and equity?
They can also return value to shareholders by buying back shares. That would go to capital appreciation.
Yep, very good. They can also return value by buying back shares. Well, so capital appreciation, it's a little tricky. So buying back shares does inherently increase the value because it's a sign that the management team thinks the shares of the company are undervalued. So what happens is, a lot of companies like Microsoft, Apple, right? These guys buy back shares. In fact, even if you guys saw Netflix when they released earnings last week, they even announced the potential to buy back shares. That's why the stock shot up after they announced earnings. One of the several reasons the stock shot up. The other being, they admitted they're not going to really need to raise external financing anymore. But bottom line is, it was a great sign, right? That's a great sign that management thinks the shares are undervalued, and they'd rather buy back shares at this price than when their price goes up, because then you can buy back less shares. So if you buy back shares, the other thing is EPS goes up, right? If EPS goes up, well, what happens? If EPS goes up at the same multiple, and we're going to get into multiples and valuation, but the same PE multiple, your implied share price goes up as well. So this is typically why when companies announce buybacks and they're in the midst of buyback programs, it's a support on the share price in a sense, because people think that the share price is undervalued effectively. It provides kind of a floor in a sense in terms of the share price, because as EPS keeps going higher and higher, right? Even the same multiple applied to that results in a higher and higher implied share price, right? So that's part of the reason why buybacks are typically viewed as a positive, whereas seeking out additional equity financing is typically seen as a negative. And again, it's not black and white, so that's why I always use the word typically, right? It's never black and white. It's typically the case, but not always. So in most cases, when companies announce buybacks, it's a positive sign. When they announce when they announce that they're going to go out and seek additional equity finance, typically not a positive sign. They're just in general, right? And share price often actually take a hit when companies announce that they're going to go out and raise more equity, because they're basically diluting their existing shareholder base. It's an excellent question. Any questions along these lines on these sort of topics? Okay, and one thing I would encourage everyone to do in general, I always say this, but just follow the press. Just like the example I just gave about Netflix, right? A lot of what we're doing dovetails really nicely to what's going on in the market, especially nowadays, right? Especially this week. It's a massive earnings week this week. Last week, a couple of companies announced. This week, a giant portion of the S&P is announcing. Make sure that you guys are following these kinds of things on a regular basis, right? If you're interested in finance, you're interested in pursuing a career in this space, in the industry, right? Within banking, within corporate finance, private equity, just these types of roles in general. research, right? Just these types of roles in general. It's really helpful to know the lingo, to make sure that you're paying attention to what's going on in the market on a regular basis, right? Just important in general, to keep track of what's going on. So just something I would strongly encourage all of you to do. And the second thing I would encourage you to do is, if you haven't done so, pick up your favorite company, whether it's Amazon, whether it's Tesla, whether it's Beyond Meat, Snapchat, whatever it is. Just pick a couple 10Ks and read cover to cover. Okay, I say that because I can sit here and just talk about what's in a 10K all day, but the best way of really truly understanding what's in a 10K, what a company is required to disclose, is by actually reading one. So I would spend, it might take a few hours, right? I would devote 2-3 hours minimum to go through one 10K, but I would do that a couple times. It's just a great exercise. And, pick a company that you're interested in that industry. Don't, if you hate technology, of course, don't pick Microsoft, right? If you hate car companies, don't pick Ford, right? Just pick an industry that you like, you enjoy, and pick a few companies and just read about it. It's a great exercise if you haven't done that, just to learn about a company's business. This is what Warren Buffett does in his spare time, by the way. He hops on planes. He's read thousands of 10Ks in his lifetime. And this is what he does. This is his idea of fun. So I'm not saying it should be your idea of fun, but it is an exercise that I would recommend you do at least a couple times, just to really get your arms around a company's, different companies' business models, what they're required to disclose, and all of that. So you can actually get 10Ks off of the SEC website. Right? Just go to sec.gov, and you can open up any company, any public companies, 10Q and 10K. I would do the 10K because it's more comprehensive. 10Q is not as thorough as a 10K, the quarterly reports. So, I mean, if you want to do 10Q, you can look at that and compare as well. But 10K is more comprehensive. So, okay, with that, let's keep going here. Here's the components of debt. Okay, essentially, they're all interest bearing. Okay, they're all interest bearing. That's the bottom line, right? Revolver, as we said, is like a credit card for a company, basically. Right? Commercial paper. Another one to point out, that short-term financing. It's typically 9 months or less. They're used to finance working capital needs. Short versus long term, right? Short term less than a year, long term more than a year. Okay, if the principal is paid back annually over time, it's known as amortizing debt. If it's paid back in one lump sum at the end, it's a bullet payment. Yeah, as we said before. Okay, so some senior debt is amortizing in nature, whereas a lot of the junior debt is just bullet in nature. What items are debt here? Well, make sure you can quickly identify what's debt and what's not. So short-term borrowings, that's debt. When you see short-term borrowings at the top of current liabilities, that's debt. Long-term debt due within a year, that's debt. Obligations under capital leases due within a year, that's debt, interest-bearing. Your long-term debt at the bottom and long-term obligations under capital leases, that's all debt. Those 5 items are interest-bearing liabilities. So if someone asks, hey, what's the debt on this page? Boom, there we go. All 5 items are debt. They are all interest bearing. Yeah, any questions on this? So make sure you can identify what's interest bearing. If you have to pay interest on it, that's known as debt. It's very important to be able to quickly identify what constitutes debt on a balance sheet. Any questions here?
If you don't mind, can you just repeat yourself again? What specifically classifies as debt? Besides like the obvious?
Yep. So basically any interest-bearing liability will be classified as debt. So on this page, we have short-term borrowings. We have long-term debt due within a year. We have obligations under capital leases due within a year. Right? And at the bottom, we also have long-term debt and long-term obligations under capital leases. Any interest-bearing liability is known as debt. So you might see a revolver, you might see term loans, high yield bonds, you might see borrowings, you might see long-term debt, right? Essentially all those terms on that prior page, right? We had this page here a couple slides ago, right? Everything on this page, if you see any of these terms, they all essentially mean interest-bearing liability or debt. That's the idea. Now, let's turn to the equity side of things. So Here's a snapshot of the equity section of a balance sheet. Okay. Now, what exactly is equity? As we said, it's a residual interest in assets remaining after subtracting liabilities. It's also known as the book value of a firm, as opposed to the market value of equity, right? Which is the shares times price. We'll get to more of that in valuation. But for now, keep in mind that the book value of a firm, that's the balance sheet value. The market value of the firm, that's what we're ultimately interested in when it comes to valuation. Now, when we break down equity, we have to break it down into two primary components: contributed capital and retained earnings. Okay, contributed capital and retained earnings. What is contributed capital? That's the investment made by shareholders, who can be common or preferred. Preferred, like Warren Buffett. He's the most famous preferred stock investor in the world, right? So you can have common shareholders like me and you, and you can have preferred shareholders who are more senior. Preferred is more of a hybrid between debt and common equity. Okay, they have preferred shareholders have a preference or priority over common investors, right? They typically get a fixed dividend. Okay, most companies don't even have preferred stock, so I wouldn't worry too much about it at the moment. If it does, it's just another claim senior to common equity. Okay, treasury stock, that stock the company buys back, right? That's known as a contra account because it reduces the value of equity on the balance sheet. Okay, and finally, retained earnings represents the earnings of a firm. It represents the earnings of a firm that it reinvests in the company, okay, rather than paying out via dividends. Okay, now, as we saw, retained earnings represents all the undistributed earnings of a firm since inception. Essentially, cumulative earnings not paid out via dividends. Okay, so basically, retained earnings goes up with net income, down by dividends. This is the third main analysis we're going to need in our model when it comes to these types of accounts where we're adding and subtracting. This is known as a base analysis. When we say base, what do I mean? I mean beginning, addition, subtractions, ending. It's the first four letters on the left. That's what I say when I say base analysis. When we say base, we mean beginning, addition, subtractions, ending. Right? We use that as an acronym. Helps us set up all the accounts nicely. All of these types of accounts, which are actually known as mixed accounts. And we're going to talk about all this, of course, in tons of detail going forward. But this is actually our third mixed account. If you recall, the first two were PP&E and intangibles. Right, PP&E went up by CapEx. We had a similar slide on PP&E. Went up by CapEx, down by depreciation. Intangibles went up by, it goes up by additions to intangibles, down by amortization. Retained earnings goes up by net income, down by dividends. Okay, and all we mean by mixed accounting, again, more on this in subsequent sessions, but all we mean by mixed account is it's a balance sheet account which consists of components which go in different sections of the cash flow statement. In the case of PP&E, it went up by CapEx, which goes in the investing section of a cash flow. It went down by depreciation, which goes in the operating section of a cash flow. Intangibles goes up by additions to intangibles, which also goes in investing. It's an outflow from investing, like CapEx. And amortization goes in operating, right? So those two have components which go in different sections of the cash flow. Retained earnings, same thing. It goes up by net income, which is the top line of operating cash flow, and it goes down by dividends, which is an outflow from financing. So anytime you have a balance sheet account which is broken out like this, right, into different sections of the cash flow, it's going to be what's called a mixed account. And this is the third one we've seen, okay, retained earnings. And again, we're going to see this in all the models we built together as well with you, so keep that in mind. Now, let's go to the cash flow statement finally. And again, we're taking a more of a high-level overview of the cash flow at the moment, much more detail on the road. Any questions here before we get to the cash flow?
Yeah, I have a question, Jordan Ruffin. You talked about it in a previous slide. I just wanted to know, like, how does one become a preferred stockholder versus not? Is it because they're a part of a business, or is there some certain like qualities that they have to certify to become a preferred stockholder?
So a lot of that's also negotiated with the company. So if you're Warren Buffett, right? I don't think he logged on to his E-Trade account and bought $5 billion of preferred in Bank of America or Goldman, right? He probably went into the company and negotiated with the company directly and invested I think it was around 5 billion, something like this, 5 to 8 billion, something along that road. But he probably negotiated directly with the company, before he made that kind of an investment, right? In terms of the dividend yield on the preferred, all of that. So, can any of us buy preferred? In theory, yes, but A, it's not as liquid, right? B, it's not as easy as just logging on to your, E-Trade or Robinhood or Fidelity account and just saying buy, because it may not be available there. So you have to really look at the company, understand the liquidity aspect of the preferred, how much of it is out there, right? And also if there are requirements to the preferred, because there could be, right? So I mean, obviously someone like Warren Buffett can go into any company he wants and probably invest if you wanted to, but most investors like you and me, right, we would probably have trouble doing something like that, because most companies wouldn't be. I mean, I know if I went to Bank of America and said, "Here's $100, give me 10% preferred," I mean, they probably wouldn't, be too kind to me. So the bottom line is that, it's something that you have to either A, have the reputation, and or B, the money, right? The level of funds to be able to make a difference. Someone like him, right? Investing in the billions. Going and walking in with 100, 1,000, even $1 million. I'm not sure if a lot of companies would even, would want that, right? So it really depends on all of those factors. I would say it's not black and white, right? Because it could be liquid. It depends on the liquidity aspect. Depends, how many investors are investing and preferred in that company, right? Depends on the need, right, for the company as well. Okay, so these are the kinds of things you want to look at. But yeah, it's not as simple as logging on to your E-Trade account, buying 100 shares of Apple or Facebook, right? It's not that simple. So.
Okay, thank you.
Again, of course, yeah. So I mean, yeah, the answer wasn't straightforward, but I mean, the bottom line is it's not a black and white type of situation. Every company is different. You would just have to examine and see if it is available for that company, and if so, if there are minimum investor requirements, if that makes sense. Okay, so basically, why do we need a cash flow statement? Well, the purpose here of cash flow, again, is to show the user inflows and outflows of cash over a period of time. It doesn't tell me anything about, well, the income statement doesn't tell me anything about cash, right? So that's why we need a cash flow statement. That's the whole point, right? Again, the income statement is based on accrual accounting. Okay, recognize the revenue as it's earned, expenses as incurred, not when cash is received nor paid, right? That's what we said about the income statement. So therefore, we need a cash flow to help us understand changes in cash during the period, starting with net income and making several adjustments to ultimately figure out what happened to cash, right? Where did cash go and how did it come in, right? Through what means? I mean, the idea here is a company might have really high net income based on accrual accounting, but frankly, if it's not collecting on its accounts receivable in a timely manner, its cash flow might be low, right? Remember, a company ultimately needs cash in order to survive, right? Because you got to pay vendors, employees, right? You have to make interest payments on debt, right? You need cash. You can't have no cash at all. That's why even in our models, we always have a minimum operating cash requirement, because ultimately you need cash to survive. You can't have literally $0 sitting in the bank. You can't run a business that way. Okay, something to just keep in mind. Rules of cash. The two rules of cash are as follows. The assets have an inverse relationship to cash, and liabilities and equity have a direct relationship to cash. Right? In other words, if an asset increases, cash decreases. If an asset decreases, cash increases. Let's do an example. Let's say a company collects on its accounts receivable. What happens? Accounts receivable drops, cash goes up. Inverse relationship. Let's say a company buys inventory. Inventory goes up, cash goes down, right? Inverse relationship. On the right side, liabilities and equity are sources of cash. So if a liability or equity component goes up, cash goes up. If a liability or equity item decreases, cash decreases. Let's do some examples. A company issues debt. Debt goes up, cash goes up. Let's say a company pays back that same debt. Okay, debt goes down, cash goes down. Say a company buys back stock. equity goes down, cash goes down, right? So you can see they both go up and down together, direct relationship. Okay, so something that's very important to keep in mind. So what is the cash flow statement?
Excuse me?
Yep.
Can you explain the rationale of prepaid expenses when it goes up and down?
Yep. So prepaid expenses. So prepaid expenses take take insurance, right? So what happens if prepaid expenses goes up? Prepaid expenses is an asset, right? So if prepaid expenses goes up, what does that mean? If it's an asset, cash goes
Down.
right. So exactly, it's an asset. So if prepaid expenses, right, which is an asset, let's take insurance for example, goes up, cash goes down, right? And the example there is, well, let's say you're paying insurance premium in advance, right? January 1st arrives. Did I make the premium payment? If prepaid expense goes up, well, I just made the payment. Cash goes down, right? Inverse relationship. Inverse relationship.
Hey, I have one question. So you were talking about stock buybacks, and I just wanted to know what account would that go under? Would that be like a treasury stock, or would it be under?
Yep, so that would be treasury stock, exactly. That would be treasury stock, and it would be part of the equity section of a balance sheet. So within equity, we typically in our models break out equity into retained earnings and this would be part of the capital component because we're talking about the shares here, not the retained earnings. So this would be part of the capital component, if that makes sense. So you could have a set line called treasury stock, but not most of our models we just have an issuance / repurchase line as an assumption, for the projections, and then just end up projecting the treasury stock as part of our common stock balance. So meaning if you buy back shares, your common stock goes down. If you issue shares, your common stock goes up. But yeah, if you look at a company's 10K or Q, you'll typically see it broken out separately. The the stock buyback, can see it as a negative because it's a contra account. It reduces the equity.
Perfect. You answered my next question. Thank you.
Perfect. Yep, that's what we do. We anticipate and we answer. Boom. Now, the reconciliation of two balance sheet columns applying the rules of cash. This is all a cash flow statement is. Okay, because you have to keep in mind there's an inverse relationship between assets and cash, direct between liabilities or equity and cash. So a cash flow statement, again, is a reconciliation of two balance sheet columns. That is it. Nothing more, nothing less. This concept will help us for the next several months here as we work through models and all of this with you. So keep that in mind. And let's actually do a simple example here, applying rules of cash. Let's illustrate the concept here of a cash flow statement with a very simple example. Here's a balance sheet. Create one more column at the end, or you can put it, I guess, right after the labels as well, wherever you have room on your page. Call change in cash. So create another column next to the last column titled change in cash. Now, the goal of the cash flow statement is to solve for cash, right? So we need to calculate the change in every single account except for cash because we're solving for cash. Now, we said an asset has an inverse relationship to cash. So what's the cash impact of accounts receivable? Well, if there's an inverse relationship to cash, how do we figure out the cash impact of an asset? Is it last year minus this year's balance or this year minus last year? It has to be one or the other. Which one is it? For an asset, is it last year minus this year or this year minus last year?
Current year minus last year?
For an asset, is that going to give me the inverse of the change?
Oh, okay, yeah. You want to take last year minus current year because that gives you the inverse, which adds cash to a cash flow statement.
Yep, exactly. So you want to take last year minus this year. Last year minus this year. That's going to give me the inverse of the change, right? So receivables, it goes up by 100. What's the cash impact? Make sure you guys are keeping track of these numbers. Accounts receivable goes up by 100, 200 to 300. What's the cash impact of accounts receivable?
Minus
Cash
Down
100.
by 100.
So I want you to write minus 100 next to accounts receivable. Minus 100. What about accounts? Or what about inventory? What's the cash impact? Goes from 300 to 350. Cash impact is what?
Minus 50.
So write minus 50 next to inventory. What about P?
Minus 50.
Minus 50.
Minus 50, right? Minus 50 next to PP&E.
Minus 50.
Okay, so yep. Accounts payable. How much did it go up by?
200.
200.
200, yep. So what's the cash impact? Accounts
200.
it's in liability, right? So with the liability, what's the order I subtract? Last year minus this year, or this year minus last year?
This year.
Current year minus last year.
So right, this year minus last year, exactly. That's the accounts payable cash impact. This year minus last year, what is 200? Right, so for accounts payable, what do we get?
$200.
Yep, exactly. So we get 200, right? Right, 200 next to accounts payable. Now, next question. Accruals. What's the impact for accruals?
Cash goes up by 75.
It goes up by, yep, so it's plus 75, right? Plus 75 next to accruals. What about debt?
Cash goes down by 50.
Yep, so debt we have minus 50, right? Minus 50 next to debt. Okay, what's next? Total equity. What happens here?
Plus 25.
Okay, so right, plus 25 next to equity. Now, what I want you to do is add up. Okay, I want you to add up all the 7 items you just gave, the 7 numbers you just gave me a number. Add up the 7 numbers you just calculated.
$50.
Okay, so let's see. 50. What does 50 represent?
The change in cash account.
The change in cash. This is what we have on the next. This is what we have on the next page here. So let's see. Here we go. Page 44. Yep. So we have 50 here on the next slide. What does 50 mean? Change in cash, which means you start with what? So what do we start with here?
$100 in cash and end with 150.
Yeah, exactly. You want to start with the $100 in cash. You add the change. What do we get? Boom, 150 in ending cash. That's all we are doing when constructing a cash flow statement. Does it get more complicated? Sure. When we start getting the mixed accounts, and of course, we're going to get into all that in detail later. But for now, as long as this example is clear, that should definitely set the stage. So, any questions on how we did the math here? How we got to 50, and that represents the change in the only missing piece, which is cash. So 100 plus the change is 150. That's the ending balance. Questions here?
Can you just break that down again? You were breaking up a little bit on my end.
Yep. So the idea is you add up all of the items in the last column to get 50, right? And that represents the change in the only missing piece. What have I not calculated the change in the last column? In cash, right? I skipped cash. I didn't calculate the change in cash, right? I calculated accounts receivable, inventory, everything else but cash, right? So when you add up those changes mathematically, you end up with a number that represents the change in the missing piece. What's the missing piece? Cash. So you take the 50, you add it to 100 to get 150. Does that make sense?
Yeah, I got it. Thank you.
Perfect. Yep. Guys, questions here? Questions? Okay, so now keep going. Here are the key components. Break out a cash flow statement into 3 sections: operating, investing, and financing, right? By definition, an asset can only be operating in a lot can only be and or financing. Right? Again, an asset can only be broken down into operating and or investing. Think about why. An asset is where you deploy your capital, right? It's not where you actually raise your capital.
Excuse me? Sorry to interrupt.
Yep.
Could you repeat that? Like the beginning of this slide that you're on right now. It's like it's like going in and out. I'm not sure if it's me or if it's everybody else, but it's like going in and out.
Yep. Let me see. Okay, so hopefully this is better. But on the cash flow statement, we break out the components into operating, investing, and financing. Now, by definition, an asset can only be operating and or investing. An asset can only be operating and or investing. A liability or equity item can only be operating and or financing. And I'm saying or and because it could be a mixed account in both, right? But a liability or equity item can only be operating and or financing. Think about why. An asset is where you put your money, not where you raise your money from, right? An asset is where you basically deploy your capital. It's not where you raise your capital from, right? So an asset cannot be financing because financing is where you get your money. Liabilities and equity has to be operating and or financing. Liabilities and equity can never be investing. Why not? Investing is where you put your money, right? Liabilities and equity is where you get your money from. Does that make sense?
I have a quick question actually on the previous slide.
Yep. Yep.
How did you get to 50? Because when I added everything up, I got 100.
Okay, so let's see here.
Because it's
Yeah, I'm just gonna put
200 plus 75 plus 25 is 300, and then there's 100 and then 350. So shouldn't that be 100 changing cash, or did I miss something?
So let's add up. Let me see. So add up. Let's go in order. So add up minus 100 plus 50 and 50. You get minus 200, right?
Yep. Yep.
Then, so that's minus 200 plus 200 is 0, right?
Okay, I see what I did wrong. Okay, thank you.
Yep. So plus 75. So then, yeah, you should get plus 50 here. So guys, this is breaking out the items into operating, investing, and financing. Right. The goal here of the operating cash flow is to reconcile net income to a cash net income figure. Okay, and this is how we break out the items so you understand what activity the cash flows correspond to. Okay, ultimately, again, the operating cash flow section reconciles net income to a cash net income figure. The investing cash flow section takes into account the purchase and sale of any fixed assets, and the financing cash flow at the bottom, right? That's the third section. That accounts for any changes in debt, stock, as well as dividends. Those are the three big buckets in financing. Okay, changes in debt, changes in stock, and dividends. Those are the three big buckets in financing. And again, we're going to be doing tons of work around the modeling and all of this going forward, which is something to keep in mind for now. Just realize that we break out the cash flow into these three buckets. Okay. Now, here's a sample cash flow. Yep, go ahead.
For inflows, could we also add non-cash expenses to inflows of operating?
Could you? Yep. So for operating cash, there would be non-cash expenses. There would be. Yep. So ultimately, what you see here at the top, that's what it accounts for. But the idea is, yes, when you're building it, you would start with net income and you would add back DNA, stock-based compensation, any non-cash expenses right away to net income. That's what we'll be doing in all our models. Right below net income, we end up with a bucket of non-cash charges and income that you have to account for. Yep, because your goal is to solve for cash, right? So here, we're just saying these are all the cash pieces. But to get to these cash pieces, you have to adjust net income, which is non-cash, for any non-cash items that hit net income. Yep. Okay, questions here on this slide? Okay, so here's a sample cash flow statement, right? You can see it's also broken down into operating, investing, and financing. You're starting with net income up at the top, right? And then the last line is, as we know, the cash at the end of the year, which should then tie to the balance sheet. Okay, so finally, we have an appendix at the end, and this is going to detail all of the different income statement, balance sheet items that we've seen, right? And some general terms as well when it comes to accounting. So I want you to make sure that you go through all of these terms, the terminology there, familiarize yourself with all of the terms, right? If I ask you at any point what any of those terms mean, you should be able to define those terms and understand. Okay, so make sure you go through those. And also, you keep scrolling further, right? You keep scrolling further. There's problems at the end. Starting on page 58, there's FSA drill questions, and there's answers for you there too. So please make sure that you work your way through these Q&A, these drill questions, to help you master all of the core accounting concepts we covered. Okay, and then the next webinar, we're going to be going into some basic Excel topics, and then subsequently after this week, we'll be taking a deeper dive on all of these concepts as it pertains to both accounting and the Excel and the modeling. This week is one overview week, and then next week, and after this week, we'll be going into more detail. Any last minute questions here?
Yeah, I had a question in regards to the PowerPoint slide a couple slides ago with the cash flow statements and the three different sections. There was something I noticed on the operating cash flow that was measured as an inflow. It says interest received. Why is interest received in like the operating section of the cash flow statement? And isn't that already taken into consideration within net income?
Well, interest is part of net income, so it's going to be inside the operating section because net income is already net of interest, income, and expense. So that's why the net income already has buried in it the interest.
Okay.
If there's any non-cash interest like PIK interest, and we'll see that down the road, but if there's any non-cash paid in kind interest, for example, PIK, PIK interest, you would add that back as a non-cash expense, kind of like DNA, to net income. Okay. But any cash interest is already buried in there. So if it was all cash, then there would be no interest adjustment. It would already be incorporated within the net income.
Okay, that makes sense. Thank you.
Hey guys, if there's any questions you have, again, feel free to reach out to me. Here's my email address again. Alok Modi, amodi@pillarsofwallstreet.com. Feel free to email me at any point, and happy to help with anything. So if you have questions, just let me know as you're going through the drills. More than happy to help. We're here for you again for this semester as you guys are going through all of these classes. We want to make sure you guys all master the material and are positioned to to succeed, of course, going forward. So just make sure that you take advantage of all the resources we gave you, as well as all the webinars to the extent possible. Okay, everyone, thank you again for attending. If you need anything, reach out to me. Otherwise, we'll see you guys on the next webinar. Thank you, and have a wonderful rest of your day.
Thank you.
Thank you.
Thank you.
Thank you.
Have a great day, everyone.
Thank you.
Thank you.